Okay, let's dive right into this explainer. Today, we're going to build a bridge between the highly exclusive strategies of the ultra wealthy and the actionable principles you can actually put to work today. We often look at the financial elite and just assume they're operating by some completely different set of rules. And, well, to some extent, they absolutely are. But here's the thing, the underlying mechanics of their success, they aren't just for billionaires. So we're going to unpack the exact asset allocation of the world's richest investors, decode their real estate strategies, and then show you exactly how to apply their ultimate wealth building engine to your own life, literally no matter where you're starting from. Now, to kick things off, just consider this absolutely staggering number, $17 million. That's the average net worth of the 233 high net worth investors tracked in the recent 2026 Long Angle Benchmark report. And listen, this isn't some theoretical pie in the sky data. This is a direct, under the hood look into the actual bank accounts and portfolios of folks ranging from 2 million all the way up to over $100 million in net worth. So, this naturally makes you wonder, right? What exactly are they doing with all that money? Are they just out there buying mega yachts and private jets all day? Or is there a highly disciplined, replicable engine running behind all this massive wealth creation? Well, the truth is, while the luxury toys definitely exist, no doubt about that, the actual foundation of their wealth is incredibly intentional, it's highly diversified, and it's heavily engineered for long-term growth and protection. Section 1. Inside the wealthy portfolio. Let's pull back the curtain and look at the actual anatomy of these high net worth portfolios, because understanding what they buy is step one to understanding exactly how they think. So there are 10 specific assets that just pop up time and time again in their holdings. We can kind of break them down into distinct buckets. First up, you've got your tangible safe havens, things that hedge against inflation, like high-value primary residences, precious metals, and fine art. Then you've got the heavy lifters, the income generators and growth engines. Think broad stocks and bonds, income-producing land like solar or timber farms, and rental real estate that throws off steady monthly cash flow. Hey, even luxury vehicles can sometimes be cleverly structured as business tools or appreciating assets. But here is a major key to generational wealth: direct ownership in privately owned businesses and private equity. You see, unlike just buying public stocks, investing directly in private companies gives these investors incredible scale, control, and some really substantial upside potential. It's absolutely one of the best paths to creating legacy wealth. Why? Because it isn't just about earning a salary, it's about actually owning the machinery that prints the profit. Now, here's a fact that catches a lot of people off guard. You'd probably think their money is entirely locked up in all these illiquid assets, right? But surprisingly, they hold heavy cash reserves. And the reason is simple. Liquidity is flexibility. Having a big pile of cash on hand gives them the superpower to buy distressed assets, swoop up undervalued stocks, or fund promising startups at the exact moment the rest of the market is panicking and stuffing cash under the mattress. Speed equals opportunity, for sure. Section 2. The real estate engine. Now, while we might not all be in a position to go buy a Picasso or launch a private equity fund today, we really need to focus on the primary engine that overlaps the financial elite and the everyday investor, and that is real estate. To really grasp just how critical this asset class is for building wealth, you've got to see this striking data point from Redfin. The top 1% of Americans own 13.4% of all U.S. real estate. That is huge. It's a foundational asset class because it essentially does three things at once. It provides steady monthly income, long-term appreciation, and some really significant tax benefits, all rolled into one neat package. Section 3, commercial versus residential. Let's dig a little deeper here and see how real estate splits into two very different investment arenas, because understanding this really dictates how you might start building out your own portfolio. So we can directly contrast the commercial and residential real estate markets. Commercial real estate, and here we're talking about office buildings, retail spaces, large apartment complexes. It has really high barriers to entry and complex management, but it comes with highly profitable long-term lease agreements. On the flip side, residential real estate, like single-family homes or duplexes, offers a much more accessible, slightly lower yield, but highly stable environment, especially for newer, everyday investors. Now, what's genuinely fascinating in the commercial space is this massive, game-changing advantage called the triple net lease. Just imagine being a landlord where your tenant is entirely responsible for paying the property taxes, the building insurance, and literally all the maintenance costs, right on top of their regular monthly rent. I mean, it completely wipes those unpredictable expenses off the commercial landlord's plate, creating this incredibly stable, predictable cash flow. But it's not all sunshine and rainbows. There's a distinct risk trade-off here. Commercial real estate is extremely sensitive to economic cycles. Think about it. During a recession, corporations aggressively cut costs, they close locations, they downsize office space. That leaves commercial landlords with massive vacancies. Residential real estate, on the other hand, benefits from a much more consistent demand. Simply put, even in a brutal economy, people are always going to need a place to live, which makes residential properties way more resilient when things take a downturn. Section 4. The Great Equalizer. Okay, let's pivot for a second and talk about why building your own investment portfolio, whether that's in real estate, stocks, whatever, isn't just a rich person's game anymore. Honestly, it's an absolute necessity for everyone. The whole landscape of financial security has completely shifted. Check this out. Today, a shockingly low 7% of private sector employees still have access to a defined benefit pension plan. Just 7%. Back in 1980, nearly 30 million workers had pensions guaranteeing their retirement. Today, that number has just completely plummeted. The whole era of a company entirely funding your golden years? Yeah, that's pretty much over. And because those traditional safety nets are just vanishing into thin air, we're seeing some very real consequences. According to AARP data, an alarming 20% of U.S. adults aged 50 and older do not have any retirement savings at all. Zero. With an aging population, what some folks are calling the silver tsunami, personal long-term investing isn't just a nice-to-have anymore. It's the ultimate survival tool for later in life. Section 5. The Compounding Effect. And this brings us right to the Great Equalizer. The truly beautiful thing here is that you have access to the exact same underlying mechanic the ultra-wealthy use to multiply their fortunes. You don't need a special license, you don't need insider connections, it's simply time and compound interest. Now, I know, investing can feel like a terrifying roller coaster ride sometimes. Take March 2020, at the onset of the pandemic. The S&P 500 dropped a stomach-churning 34% in just over a month. But if you held on tight, it rebounded and actually ended the year up over 18%. Since 1980, the market has seen positive returns in 37 out of 45 years, despite an average intra-year drop of 14%. The takeaway? Surviving those terrifying, stomach-dropping falls without panicking and selling out is absolutely mandatory for growth. Historically speaking, the longer you stay buckled into this ride, the closer your probability of positive returns inches toward absolute certainty. Think about it. On any given day, the stock market is basically a coin toss, a 53% chance of being positive. But extend that horizon. Over a 1-year period, it jumps to 75%. Over 5 years, 89%. Over 10 years, 94%. And over any rolling 16-year period in the history of the S&P 500, the probability of a positive return has literally been 100%. Time completely smooths out the volatility. Just look at this data illustrating the pure magic of sticking with it. A single $10,000 investment made in 1990 and just left alone in an S&P 500 index fund would have exploded into over $339,000 today. That's thanks to an annualized return of 10.6% with dividends reinvested. Compare that to just leaving it in cash under the mattress, where inflation quietly eats away its purchasing power year after year. And the sheer math of time gets even more staggering when you compare starting ages. If you invest just $500 a month starting at age 25, assuming a 10% average return, you hit age 65 with a portfolio value of over $3.1 million. But if you wait until age 40 to start investing that exact same $500 a month, your final result is slashed to under $670,000. Think about that. Those 15 lost years literally cost you over $2.4 million in compound growth. To really drive this compounding lesson home, just remember this incredible dynamic. An investor who starts at age 25, but only achieves a highly conservative 5% return, will actually still reach retirement with more money than an investor who waits until age 40, but manages a massive, market-beating 10% return. It's wild, right? Time does the heavy lifting. Time in the market truly matters so much more than your rate of return. So the financial elite might have their millions, their private equity, and their fancy triple net commercial leases. But the most powerful wealth-building asset on earth isn't locked behind some VIP velvet rope. It's simply time. Whether you have 10 years or 40 years ahead of you, compounding is just waiting to work its magic. So the only question left to ask yourself is, how will you choose to spend your ultimate asset today?